Hello, everyone. We will give you all a minute to dial into the Zoom, and we'll start very shortly. Hello and welcome. We will begin today's edition of Riveron's Ask the Experts. Today's topic is lease accounting, ASC 842 leases, with a specific focus on private companies. The time is now. With just over 5 months to go, this should be a relevant topic for many of you. We look forward to the discussion and appreciate that you took the time out to join us today. My name is Michael Cahill. I'm a managing director with Riveron out of our Washington, D.C. office. Today I'm joined by Isaac Heller, the CEO of Trullion. Isaac is the co-founder and disruptor in the modern accounting technology space. He's worked in the accounting and lease space for a number of years, so he will bring a great view of technology and how technology is helping companies automate through AI and streamline the lease accounting adoption. So thank you for joining us, Isaac. Also today are two of my colleagues, Craig Rawlings, also based out of Washington, D.C. Craig is a leader in our lease accounting practice with lease accounting systems, processes that companies are using to implement the standard, and then the numerous accounting policy elections that companies have to go through. So a great resource. And finally, Amelia Legowski joining us out of our Chicago office. Amelia has about 10 years of experience in the accounting, audit, and advisory space, with the last couple having an emphasis on lease accounting. So thanks to each of you for joining us and for taking time to prepare and share. Looking forward to our discussion today and welcoming the Q&A from the participants. We'll begin with a bit of brief housekeeping, just so we have the table set. All of Riveron's webcasts are available for your review on our website, riveron.com, past and upcoming, so please visit that as you see fit. To obtain your CPE today, you need to respond to 4 polling questions in a timely manner that will pop up. Please allow pop-up blockers or on your computer so you don't have any issues with the polling questions. If you have questions or issues during the webinar, please use the Q&A function within Zoom. Evaluation forms and CPE certificates will be emailed to you, typically within about a week of the webinar. The on-demand video is available, however, it is not eligible for CPE. And then finally, you will receive a follow-up email that will include access to the webinar recording, today's deck that we'll cover, the ability to join our webinar mailing list to receive future invites, and then contact information for each of the presenters. The market has changed. Isaac and I will talk a little bit here just about what we see, what our interpretation is of, a quick recap of the past, but then also how we see it playing out for the private companies. And with public companies, the adoption was a little over 2 years, 2.5 years ago. There was a large number of public companies coming into the funnel at the very same time, as they all had to report on their adoption in Q1 of 2019. So everyone went through that period. The FASB has delayed the standard a number of times. Amelia will talk about that in a bit, but what we're seeing is really beginning this quarter, and then probably for the next 1.5 to 2 years, private companies will come into this at different times. First of all, there's many more private companies than there are public companies. They're very much more diverse in their size and their focus, but also their reporting cadence. So they will, have a GAAP reporting obligation on a quarterly basis, and those companies are going to have to report early in 2022, adopting 1/1/22 and reporting on their first quarter if they have bank or investor reporting obligations. Those that have covenants that are a little more lenient and they're only providing annual financial results to their investors or their banks, those companies will have a little bit longer runway when they report their audit results for 2022 and early or the first half of 2023. So I think we're going to see higher volume because there's more companies. They're going to be made up of companies that have smaller accounting and finance teams. So leveraging technology and AI is going to be something that's appealing to them because they don't have the teams that can get through this. And then the timeline will stretch just because they've got more relaxed timelines. So Isaac, from a technology space, what are your takes on how the market's shaping up?
Yeah, well, the way the market's shaping up, I think a lot of it goes back to what you mentioned about the delay. So if you think about the reason the standard was delayed, it was actually two delays, right? This thing has been delayed twice. The first delay was related to readiness. And if you look at the Wall Street Journal article, the FAS, Russ Golden at the time came out and said that companies weren't ready. It was too complex of a standard. Software vendors weren't ready. And so thus that led to a 1-year delay. The second 1-year delay was related to COVID, which we all know very well. So if you think about what's happening now, as it relates to the first delay, people are starting to understand how difficult that adoption is. So they're starting to look for services work and software work right now as the new adoption comes in, the new standard comes into play. The second factor, COVID, has been interesting because there's been a renewed emphasis on leases and assets, tangible things in the portfolio from the CFOs and across the board. And also there's been a renewed emphasis on automation and technology. So when you move to a digital world and a virtual world, it becomes a little bit harder to manage a lot of these processes in a decentralized format. So because of those delays, we've seen them kind of play out in the market now, where you've got CFOs who are more open to technology, taking a little bit more seriously, spending a little bit more time on getting ready for this final adoption date.
Yeah, no, I think that's a great point. I think just in general, there's been a lean towards technology and automation just in the virtual world. How can we leverage that with teams that are virtual? So it'll be interesting. Thanks for sharing that, Isaac. Now we will go through our first polling question. The polling question, it should be up on your screen. To determine the lease classification under ASC 842, how many criteria need to be reviewed? A, 3, B, 4, C, 5, D, none. 842 does away with lease classifications. Amelia, while we wait for the results to come in on that, what are you seeing in terms of more or less straightforward? Is ASC 842 more or less straightforward than 842 in terms of the criteria?
Sure, absolutely. My personal opinion is that the new criteria the FASB has set is less straightforward under 842 versus 840, which means there's going to be more subjectivity when companies are determining the proper classification between operating and capital leases. So to me, more subjectivity typically means it's more important than ever to document all of your considerations thoroughly in order to support your conclusions around your lease classification. So unfortunately, 842 is a little more ambiguous than 840.
Yeah. Okay, well, that'll make it interesting. Okay, so we've got a bit of a variety here. It is 5, so that's good to know. But we'll cover some of that now. And Amelia, I know you're going to cover some of the fundamentals, but also some of the things that we've learned and some of the I think you've got a couple of good tools in your presentation materials that companies will be able to take away from this. So please jump in with the 842.
Yes, thank you. I thought we could start our discussion around this standard with a quick history lesson. So historical guidance and disclosure requirements under 840 led to stakeholders and financial statement users manually calculating lease obligations themselves, which led to the SEC being criticized around the disclosure requirements for leases, because why should so many people who want to understand the same metrics have to calculate them on the side when my financial statements should be telling me everything I need to know? So this led the SEC asking for greater transparency in financial reporting with respect to the treatment of leases, which ultimately resulted in ASC 842. Overall, ASC 842 does provide greater transparency into a company's leasing activities by moving the assets and liabilities related to the company's current lease obligations onto the balance sheet, and also enhances lease disclosures to include both qualitative and quantitative information. So now our stakeholders will be provided with plenty of information to digest for them to have a greater understanding of your company's lease portfolio. So now I'm going to take a little bit of time to talk about the timeline and adoption methodologies. So this standard, as we all know, has already been adopted by all publicly traded entities, however, is required for all privately held companies to adopt no later than January 1st, 2022, which, as you are very well aware, is only 5 short months away. So you have a couple of options on how you can adopt. You can either select the modified retrospective model, which requires you to apply the effects of this standard to each reporting period presented in the financial statement. So just like the title implies, this method is retroactively applied to all prior periods presented. And then you've also got the optional transitional method, which allows you to adopt this standard as of an effective date, and the cumulative effect of the adoption is reflected in the retained earnings balance as of the effective date. So no changes are needed to any prior periods being presented then. So next, I'd like to discuss a summary of key changes in lease accounting guidance. Since the main spirit of this presentation is to provide a high-level overview of the standard with an emphasis on how to optimize technology to troubleshoot common adoption challenges, I'm not going to be taking a very deep dive into any technical aspects of the standard. But if a deep dive is something that you're looking for, Riveron does have free webinars at riveron.com on our insights page. So check that out for all kinds of good stuff. But for now, let's talk about some major items to note when comparing 842 to 840. So first topic I'd like to discuss is around the lease classification criteria. So it's slightly different. Under 842, we refer to capital leases now as finance leases. And the original 4 criteria still exist under 842. However, 842 has eliminated those bright line tests. So that 75% and 90% tests we're used to seeing, those are now gone. So that's where there's more subjectivity in this analysis. And then 842 has also added a 5th criteria, which focuses on highly specialized assets. So under this 5th criteria, if a leased asset is so specialized that at the end of the lease term, it will have no alternative use to the lessor, then the lease is immediately classified as a finance lease. From a lessor perspective, the most significant changes align the profit recognition requirements under the lessor model with those under ASC 606 and amend the lease classification criteria to be consistent with those for lessee. The classification criteria are similar to that for lessees, with an additional requirement to assess collectibility to support classification as a direct financing lease. Also, in order to derecognize the asset and record revenue, collection of payments due must be probable for sales type leases. And from a lessee perspective, the biggest change that you're going to see is you're going to be throwing all of your non-cancelable leases that have terms greater than 12 months on your balance sheet. So if the term is less than 12 months, accounting shall remain under ASC 840. So now let's talk a little more about throwing these assets and liabilities on the balance sheet from a lessee perspective. For all leases greater than 12 months old, after determining whether the lease is finance or operating, the present value of the lease obligation must be calculated using a discount rate. Any upfront direct costs, prepayments, or lease incentives are also included on the ROU asset. This can include leasehold improvements that are required by the lease agreement and is not reimbursable by the lessor, or commission payments to incentivize existing tenants to leave. So here's a bit more consideration needed up front when computing an ROU asset. Further consideration also needs to be given between a lease and non-lease components. And I am going to take a little bit more time to dive in here to address the question we did have come into the queue. So lease components are defined as a cost to use the underlying asset and are typically specific to base rent expense, while non-lease components are thought of as a good or service being transferred that is not the right to use the underlying asset. Examples of non-lease components are common area maintenance, property taxes, and property insurance. Quick nuance regarding how to account for non-lease components as they relate to property taxes and property insurance is that these are lessor costs that do not provide a benefit to the lessee. As such, further consideration here is needed. We need to determine whether we have a gross lease or a net lease. In a gross lease, lessee payments of taxes and insurance are fixed as part of the rental payments specified in contract. In a net lease, the lessee will make variable payments. So since property taxes and property insurance payments are fixed, Since the property taxes and property insurance payments are fixed and are included in the rental payments in a gross lease, US GAAP determines the nature of these payments to be consideration in the contract, which means ultimately the property taxes and property insurance payments are to be allocated to separate lease and non-lease components and can impact the measurement of lease costs, assets, and liabilities. US GAAP goes on to note that in a net lease, the lessee's payments of property taxes and property insurance are not considered consideration in the contract because they are variable. As such, ultimately, if you're a lessee and you're paying for property taxes and property insurance, which are variable in nature, US GAAP notes that the lessee would expense these costs as incurred, as they are not to be considered part of the ROU asset or lease liability. So ultimately, this portion of ASC 842 comes down to simplicity and trying to keep the adoption as simple as possible. So since variable expense is not always measurable up front, for you to include those variable costs in your ROU assets and lease liability calculations would require you to need to keep remeasuring your ROU asset and lease liability each time your variable costs change. As such, to support the effort to make your adoption as simple as possible, US GAAP is helping us out here by saying expense all your variable costs as they are incurred to avoid needing to remeasure your ROU asset and lease liability. So big picture, I almost forgot something. So when computing the ROU asset and lease liability, it's also important to document your considerations around the lease term. Under ASC 842, if it is reasonably certain that a renewal will be exercised at the end of the lease, the renewal period is to be included in the computation as well. So high level, big picture, for both operating and finance leases, the present value of the lease obligation is recognized as an ROU asset and liability. For finance leases, the asset is amortized using a straight line method over the lease term, and the liability is wound down using the interest method. This generally leads to front loading the expense on your income statement. For operating leases, the way the asset and liability are wound down results in a relatively straight line hit to your P&L.
Amelia, with regard to the bright line test, how are you seeing, now that that's gone away, how are you seeing the companies handle that with their adoption of 842 since that's no longer in the standard?
That's a great question, Michael. So despite ASC 842 removing the bright lines classification requirements, I always recommend that my clients reinstate them by way of a policy election in order to remove as much subjectivity as possible. This will allow for more consistent compliance with the standard. Auditors are typically comfortable with this approach, provided they see some management judgment in this decision as well. So this is something we definitely consider as a best practice for you to consider implementing to alleviate some of that subjectivity that ASC 842 presents.
Great.
So this kicks off our discussion on the policy elections you can make relating to practical expedients that are available to you. We flagged some of these as best practices to highlight which ones we believe would best streamline the adoption effort, as well as promote consistency in the application of 842 going forward. Understanding and documenting the adoption of these policies is a critical step that needs to be taken to adopt ASC 842. So I'll take us through a quick crash course through each. We just discussed the use of bright line thresholds, so let's talk about lease and non-lease components now. So we did just discuss the nuances in determining lease and non-lease components in 842, but 842 does require you to separate those. So a lessee can elect by underlying asset class not to separate the non-lease components of a contract from lease components, which means the lease and associated non-lease components will be treated as a single lease component. This generally results in straight line recognition of the component and is great, as this will significantly reduce the burden of maintaining compliance with 842, as determining the standalone price may be difficult and time consuming. As such, lumping all the components together does simplify this process. However, this election does lead to a larger ROU balances, which could ultimately result in more finance leases and the need for careful impairment consideration if the value of the ROU exceeds the market value. Another drawback is one we just discussed with respect to variable costs. We do not recommend electing this expedient if your non-lease components are variable in nature. So while this is a great consideration to take, we do not see this election taken that often. The next policy election to discuss is a package of practical expedients. So your company, the essence of this election is that your company would not have to reassess any of your expired or existing contracts or any lease classifications or any initial direct costs that existed prior to the effective date. So it's This policy election is amazing because you do not have to go back and reassess how you've accounted for your lease portfolio under 840, so long as there were no identified errors. So it's a huge benefit that save a ton of time when implementing this standard, as you'll only have to account for your portfolio under 842 for all the new leases you've entered into after the adoption date. As such, we do believe this is a best practice, as we do see the majority of our clients adopt this package of practical expedience. Next policy election you can make relates to hindsight. So hindsight can either be used with the package of practical expedience just mentioned or on a standalone basis. The hindsight practical expedience states that when determining a lease classification, a company can consider the actual outcome of lease renewals, termination options, and purchase options that were previously evaluated, and also allows for you to assess any impairment of right of use assets specifically for the periods presented in your financial statements. So while this expedient does give the lessee the ability to reassess the population of leases, which will to determine if the operating lease could flip to a finance lease, this would increase your EBITDA, which is desirable to some, but it also allows for more subjectivity and can be labor intensive to apply this expedient for a company with a large lease portfolio. So the majority of our clients do not elect to use hindsight for these reasons. Next up is land easements. This practical expedience can be applied separately or in conjunction with the package of practical expedience and allows entities to continue to account for their land easements under ASC 840. We do not typically see a bunch of land easements. However, should your company have any, this is a great expedient to adopt. Next up relates to materiality thresholds. So this policy election allows you to determine a materiality threshold that will allow you to expense the cost of a lease as it's incurred versus capitalizing an ROU asset under 842. If this policy election is made, it is important to consider and document the effects of not recognizing the ROU asset and lease liability. We would also recommend using a similar threshold to capitalize a fixed asset addition in order to encourage consistency across policies and the related application of those policies. But this is a great one that could greatly reduce the impact of implementing ASC 842. As such, we've identified it as a best practice. Next, I'd like to discuss the treatment of short-term leases. So you can, as an accounting policy, your company can elect to apply or not to apply recognition requirements under 842 to short-term leases, i.e. leases that have a term less than 12 months. We see this election as a best practice as it is commonly made and does save a lot of time in applying ASC 842. However, consideration is needed to keep track of the expense activity in order to be able to disclose the activity accurately and completely. So while you don't have to capitalize an ROU asset and recognize a lease liability, you will still need to be able to disclose the activity under your short-term lease obligation. Next, we're going to talk about asset classes. So this policy election can be made to identify and define asset classes as they relate to leases, such as real estate, furniture and fixture, automobiles, etc. We do see most companies define their lease asset classes to be similar to their fixed asset classes. And overall, this is an important policy election to make, especially if you are going to be adopting other practical expedients that allow you to account for certain activity different by asset class. As such, we've considered this election to be a best practice. For example, if you're going to be making a policy election to include all of your non-lease components as lease components and computing your ROU asset and lease liability, it is best practice then to adopt this policy election as well, so that your asset classes are clear and can be consistently applied as new leases enter your portfolio. Next up, we'll talk about determining the economic life by asset class. So management is going to need to determine a policy for defining economic life by asset class, which is going to be a driver in determining proper lease classification. It is common for management to define the economic life of their asset classes to be consistent with their fixed asset useful lives. This does help remove some subjectivity out of determining the lease classification process. As such, we do recommend this election to be made as a best practice. Next, let's talk about the definition of reasonably certain. Allowing the lessee to define how to determine whether a lessee is reasonably certain to exercise an option to either extend or renew, or is reasonably certain not to exercise an option to terminate a lease is integral to determining the lease term and the lease payments, which ultimately impacts your ROU asset and lease liability. This will help you apply a consistent thought process around the term of the lease that you decide to calculate your ROU asset and lease liability. While this does remove some subjectivity, the lease term is typically straightforward. As such, we don't see this election taken too much. Next, let's discuss your incremental borrowing rate and the discount rates used. So as mentioned earlier, the present value of the future lease payments is to be capitalized as your ROU asset and recognized as your lease liability. To compute the present value, a discount rate is needed. For a lessee, the discount rate for the lease is the rate implicit in the lease unless that rate cannot be readily determined. To determine the rate implicit in the lease is typically very challenging, as this is a measure that is rarely disclosed. In this case, the lessee does not have a rate implicit in the lease. The lessee is required to use the incremental borrowing rate. The IBR is a rate at lease inception, where the lessee would have incurred to borrow over a similar term the funds necessary to purchase the leased asset. Computing an IBR can be quite a challenging task, but luckily there is a little relief in the sense that non-public companies are permitted to make a policy election to use a risk-free rate. As such, we definitely recommend adopting the use of a risk-free rate if a rate implicit in the lease does not exist, to allow for an auditable trail that is relatively easy to implement, which is why we consider defining this approach and electing to use the risk-free rate as a best practice. And lastly, separating land and building components. For leases that include a land element, such as you're renting land and a building or land and integral equipment, the right to use the land is considered a separate lease component unless the accounting effect of separating accounting for the land element would be insignificant. The board considered separation of building or equipment and land components in situations where there would be no effect on classification as inconsequential from an accounting perspective. So management can consider implementing a policy with a percentage threshold of fair market value to separate the building and land to help enforce this. This policy election is made on a lease by lease basis though. So typically we do see the land and building components combined, which we feel is reasonable, as this election does introduce more subjectivity into your adoption considerations. And lastly, I would like to review the adoption checklist with you from a starting point of your adoption process through to the end. So step one is to identify key stakeholders to own the analysis and assist in implementation. Consideration should be given to those that initiate and record lease transactions. Timelines should also be established, and regular touchpoint meetings should be scheduled to ensure progress is being made towards adopting 842 by January 1st, 2022. Step two is to gather a listing of lease arrangements. Many public companies said the greatest challenge of adopting 842 is accurately capturing a complete population of leases and gathering the necessary data required to make accurate lease assessments. Under the old lease guidance, companies were not required to capitalize operating leases. My headset just died. Can you guys hear me?
Yes, we can.
Okay, sorry about that. So many public companies said the greatest challenge of adopting 842 was accurately capturing a complete population of leases and gathering the necessary data required to make accurate lease assessments. Under the old lease guidance, companies were not required to capitalize operating leases, meaning many arrangements were not assessed in detail nor segregated into specific accounts or financial statement line items. As a result, knowing exactly where to look for leases posed a significant challenge for most companies. Step three is to verify the completeness and accuracy of the collected data. Completeness is also one of the biggest areas of focus for external auditors. Companies were required to perform extensive procedures and prepare detailed documentation outlining how they were able to obtain comfort that they had identified a complete population of leases during the adoption of 842. Completeness can be obtained through a vendor spend analysis, discussion with stakeholders across the entire organization. We recommend holding discovery sessions with all functional organizations, including operations, IT, procurement, etc., to understand what assets are being used and what contracts are out there. We also recommend conducting field or site visits to go out and see the equipment being used, which can also provide a further understanding of the assets and how they are being used. And lastly, we do recommend reviewing your master contract list if you have any. That's also a good indicator that you've covered all your bases. Additionally, the change in the definition of a lease under 842 means that many types of service arrangements may contain an embedded lease. These types of arrangements were typically not assessed for potential lease implications under the old lease guidance. Some questions you can ask yourself to determine whether or not there is an embedded lease are, is there an identified asset? Is the asset on premise at the customer location? There's plenty of other questions you can ask, but these definitely should be discussed throughout the discovery phase with identified stakeholders, site visits, and reviews of master contracts. Step 4, review the practical expedients we just went through together to formulate an adoption policy best fit for your company. These are very important to understand as they can save you a lot of time during your adoption. During this phase, it is critical to review debt covenants for provisions specific for changes in financial ratios arising from changes solely from a change in GAAP requirements. We suggest calculating the impact of 842 on debt covenants and communicating any expected changes with existing lenders to negotiate an amendment to the covenant or restructuring if needed, because nobody likes surprises. Step 5. Once you've gathered all the data and finalized the accounting adoption policies, now begins the process to determine the appropriate lease classification of each.
Amelia, we can't hear you. So I think let's go to the polling question, but I think what I really like is the last two slides that Amelia had up I think are going to be really good dashboards. There's the policy election and then there's the adoption checklist. So really good takeaways for companies out there that, I think print those out, we'll send the materials out, print those out and pin them on your desk, or they're going to be helpful as you're going through the adoption. So polling question number 2, as you're evaluating ASC 842, do you intend to adopt using A, Excel, B, a lease specific software, C, uncertain, or D, you already have a solution, a software solution of some type in place? So I'll wait for those. Isaac, I know, from your perspective, as a technology leader in this space, what are the headwinds you're seeing as you talk to people about, as they're wrestling through their decision, right? Are they going to do it manually? Are they going to use Excel? Are they going to adopt the technology? How do you tackle that when you're having conversations?
Yeah, great question. I mean, a couple things. First of all, at the end of the day, you got to get your CFO and your broader team on board. So what that entails is understanding the ROI of purchasing software. It's not just compliance, it's about centralizing expenses, automating quite a big process, a big material expense across the organization. And so, a lot of companies are interested in technology. They do, request a demo and talk to their advisory partners about the technology solutions. The headwinds they get is internally when they're talking to a CFO about this new lease exercise and trying to justify the ROI, both on the cost savings and the efficiency of compliance, but also in finding some incremental value in the organization by using software.
Thanks, Isaac. So the responses are in, and it's an interesting mix. So we're pretty much split across the board between the Excel, some type of solution, and uncertain. So even split, and I think that's indicative that companies are still going through the process, right? I mean, people this has been deferred a number of times. We've gone through a pandemic. That people are wrestling with other priorities. So this is going to come to light, and folks are going to shift one way or the other. But pretty indicative of where we're at right now. So thank you. Isaac, now you're going to take over and go from here and talk a little bit. And I'm excited because, as the folks are evaluating, you're going to get to see what the software solutions can do, specifically Trullion, but really looking forward, Isaac, to your sharing how you guys are tackling this.
Yeah, definitely. Well, look, the way we look at the market as a technology company, as a financial technology company, is it's a completely new era. So the things that Amelia, has reviewed for us today regarding the new standard, it's tough, it's complex, right? It used to be a straight line expense. Leases did not have a big spotlight on it. Now there is a much more complex balance sheet accounting requirement. And this is happening across the board with FASB and IFRS and accounting regulators seeking more transparency. So at the same time, financial technology is innovating and catching up with this to keep up with the new era. If we go do a little history lesson with accounting technology, accountants were really some of the pioneers. So when you think back to the 80s and 90s with Oracle, SAP, and Intuit, these were some of the very first business database use cases. Over time, moving into the cloud, everything from Zero to QuickBooks Online to QuickBooks Cloud to NetSuite. And then now what we've seen in the past, I would say 5-6 years, is software powered by AI, or with at least an embedded component of AI or OCR within it. And so we're living in that era now. So it's timed well with these complex exercises and CFOs wanting to innovate and automate across the organization. The interesting thing is the existing landscape of a lot of organizations is siloed. It may not feel like that at times, but when a standard like this comes in, it's definitely going to feel like that. So on one hand, on the left side, you have source data, right? So that could be documents or invoices or a CRM system, or even a big Excel database of vehicle leases, for example. And then the accounting team is, reviewing and managing that. And then a lot of times it's put into the ERP. So when audit comes in, that whole process is disconnected, but ultimately the stakeholders on the other side are trying to get as much transparency as possible in the most efficient way possible. And what's interesting, what we saw is from a technology perspective, when these standards came into place, so you think about revenue recognition, you think about things related to cloud agreements or lease accounting. When they came in, there wasn't necessarily an out-of-the-box or integrated solution within companies' main source of main system of record, like the GL or the ERP. And so what happened is with these accounting standards, and also I would say that the complexities of business models, the rising complexities of business model have created actually more risk in a way, because so many of these processes have happened outside of the systems of record. So if you think about lease accounting, a lot of the people mentioned they're using a spreadsheet. That's great, and we do think that works, but it's introducing another disconnected point within the process. Now, what's interesting is AI. AI, I would say when it first came out, it was a little bit jolting, right? Especially in the accounting industry, there were questions of, is it going to change processes? Is it going to replace jobs or tasks or things like that? I think the dust has settled, and most companies are now past the early adoption and on the maturity curve, thinking about how it can enable more accuracy and more efficiency. And again, we're at this backdrop of new standards. So the new standards are going to continue to come in, and somehow we have to bridge the gap. Just to level set, a lot of us are at different stages of our awareness of AI and these tools. The types of AI that we see are things like OCR. So OCR is what you would think of with an invoicing software that can read invoices and help extract the data very, very quickly. Another type of AI that you hear about, like a buzzword, is NLP, or natural language processing, or neuro-linguistic processing. The cool thing about NLP is actually helping provide some interpretation or some indication as to whether something is a date or even a start date or renewal date. And then if you hear the buzz about machine learning, all machine learning is the algorithms within the tools that are helping improve the accuracy and repeatability of the existing processes. And so within the accounting and the finance world, there's really a spectrum of how the AI is applied. So you think about structured data, which is like invoices. You could have 1,000 invoices that are exactly the same. That's a pretty good use case for AI and machine learning. On the other hand, you have completely unstructured data that lives outside of the ERP and even lives outside of the audit process, which could be, board meeting notes or emails or verbal agreements that can actually be really material. Those are a lot tougher to get to, right? And a lot of these things will never be addressed by AI because of the variance in interpretation that's required, especially as it comes to, oral and verbal interpretation. Now, where we sit as Trullion is we sit in the semi-structured space. So our software has AI embedded in it, which can help pull out key terms from contracts and other types of agreements, especially within lease agreements. So when we look as a technology company, when we look at this process, and again, we think about all of the standards coming in and the opportunities for innovation, we say, okay, what's the process today if you use Excel? Now, let me be clear. We are a technology company, but we use Excel all the time. We love Excel. Excel to us is an automated tool, believe it or not. It is a piece of software. But there's a magic number when it comes to leases. And once you hit about, I would say, 10 assets, 10 leases, it becomes much more difficult, especially on day 2, to keep up with that process. So it might be easy to get an initial right of use asset with a few assets or leases in a spreadsheet. And in fact, our company, we only have a few leases. We would do it in Excel, to be honest. But once you get to day 2, and you get into modification accounting, and you go through transactions, and you have more rigorous reporting requirements, then the software can provide those controls and automation to help save you time and streamline the process. So today, if you look at the process, you're reading the PDF, you're extracting the data, putting it into Excel, and running reports. And then we actually work with a lot of auditors. The audit teams are now recreating that process, or in some cases, even just sampling a fraction of the work that you've done to make sure that they can sign off on your ASC 842 audit. And that's really where Trullion came into place. So we looked at the landscape. There's a lot of great lease software and Excel options out there, but they revolve around manual entry. And there was an opportunity to start to connect the dots in the workflow and really jumpstart your project. And so what's unique about what we do is we take the source data. This could be a PDF lease or even a big Excel file with multiple leases, and we tag it. The software can actually suggest key data points and help you start to accelerate your process. It'll help present you with the judgment and the questions, a lot of which Amelia presented, and help with some real-time accounting and workflows. And then also provide you with continuous insights, which can be basic, like journal entries and disclosures, but also some reporting and analytics. Now, the cool thing here, if you look at the center, is how you can leverage your teams and your partners like Riveron. So, for example, if you were to use a software like Trullion, instead of doing the data extraction process outside of software and reading a bunch of contracts and putting them into Excel and then uploading to a tool, you could start the process with the software. And what that means is not just that you save a little bit of time, but the audit trail. So your actual audit trail starts with the contract. So if you identify a key clause or a tenant improvement, it can tag it within the document. And so that way you can show your auditors your work. And when that critical event comes up and there's an alert, you can go right back to where you tagged that data.
Thank you, Isaac. I think the workflow and some of the things that are mentioned at the end is it's going to be, I'd say, a fairly compelling case, especially once you get over that critical mass, and just the maintenance is going to be too much to do manually in Excel. So we should see a lot of movement that way. So now we'll go polling question number 3. How familiar are you with embedded leases? That embedded leases may exist in your current portfolio? A, not familiar. B, somewhat understand that vendor contracts need to be assessed. C, we have already completed our analysis and have a full population. D, what is an embedded lease? So we'll give you a couple of seconds to answer that. Craig, what are you seeing as kind of one of the biggest hurdles with embedded leases? Where are people getting hung up on that?
Michael, the embedded leases definitely had everybody very stressed out at the beginning because it was a new concept that needed to be applied. And I think one of the more difficult areas is, I think there's a ubiquitous understanding that embedded leases don't necessarily say lease on the contract, and that's what needs to be uncovered. But ultimately, what I've found is where the definition involves a specified asset. So an embedded lease needs to be an asset that is explicitly or implicitly specified in the contract. So, is it mentioned in the contract that you'll see it or alluded to in a very detailed way? Is it physically distinct? And most importantly, does the supplier have the right to substitute or not? And often that substitution right can be a little prickly, because coffee machines, oddly enough, are one of the biggest areas what we've seen where, it's potentially an immaterial expense, but it doesn't say lease on the agreement. And coffee machines sometimes have the right of substitution, sometimes don't. And if the supplier can change out that coffee machine at any point in time, then it wouldn't constitute a lease. If they couldn't, and they specified this asset with this serial number, that's what you guys are going to have unless something goes really wrong with it, then it typically would be a lease. So just an example of where we've seen some trip ups.
Yeah, and I think there's just a little bit of mystery with the embedded lease. Like you said, it's not called a lease, but I think we've got a pretty good playbook in terms of how we've helped clients work through identifying them to make sure that, it's a completeness effort. So you have all of your leases embedded or not. Thanks, Greg. So the results are in, and it looks like, most folks, 57%, somewhat understand that the vendor contracts need to be assessed. So more to come on that. And Craig, so now Amelia started us with some of the fundamentals, the background, some of the policies, and Isaac took us through, how technology is enabling companies to do, adopt 842 more efficiently. Craig's going to talk a little bit more about the controls, some of the processes, how we're going to actually go through the effort. So Craig, looking forward to hearing your bit here now.
Great. No, thanks, Michael. And thank you to everybody for joining. I know 842 is not exactly the topic that everyone wakes up in the morning to address, but it's been one that has created such difficulty that it's important to get underneath the theory and then the practical application. And that's essentially what we have attempted to do with this presentation. Is we've had Amelia lead with a lot of the technical areas that need to be understood when you're applying the standard. We've got Isaac, who's talked through how the technology is so important in the adoption, and I'll go through that shortly. But then my section is really going to be a framework for the practical application of all of these and putting it together, and hopefully getting or distributing an understanding of how to approach this systematically, so that there's no headaches during the implementation. So just talking through the pillars here of adopting the standard, the first thing that we're going to have here is the transition. That's going to be your day one entries, where previously your operating leases were just expensed. They're now going to show as a right of use asset and liability. So that's the first thing that needs to be considered. The second is the reporting. And I'll get more into the detail there, but the reporting is often an afterthought, and that's something that needs to be considered up front, because ultimately it's the reason the standard is being created. The future state activity of all of the lease agreements that you have in the system, and then finally how the technology is going to work. And what this graphic represents is the internal control environment that needs to underpin a lot of this, and I'll talk through why that is important. And hopefully this also illustrates to a lot of the audience why 842 has caused so many headaches, and that it's not just a lot of noise that's being created to scare everyone. It's truly a complex standard because there's so many variables that have to get considered. So just from top to bottom on the right hand side here, talking through the transition, the idea there is to produce accurate and complete accounting, and there are a lot of factors that go into that. It's a function of appropriate data abstraction more than anything else. That's so critical, because you need a team that's going to understand how the standard is structured, so that any of the subjective applications that need to be made to the theory are being done correctly. And then this all needs to be very comprehensively documented. So the methodology, for example, on an embedded lease analysis needs to be done very carefully, because the auditors are going to review how that was done, and they're going to decide ultimately how appropriate it was and if it would have actually detected embedded leases. Then all of the practical expedient applications as well. How did we think through that? Was this something that we just decided to do, or was there, critical thought applied that makes sense? And we found that auditors are pretty strict on this, both private and public companies, more so obviously on the public side, but even with private companies, they want to dig in. They want to understand that the client is applying the guidance. And the guidance, admittedly, is not all the same either. There are a couple of deviations, some small, some big. The second, the reporting. So obviously we've got a new footnote disclosure that needs to be added to the financial statements. We've got a checklist as well, which we'll be producing on our website in the coming weeks. And that checklist is just going to be end-to-end, soup to nuts. This is how the adoption needs to go. And hopefully it'll just act as a guide for the private companies to know that they're actually ticking all the right boxes. So that'll be published hopefully in the next 2 or 3 weeks. And that's, again, something to present to the auditors, because you've got to begin with the auditors in mind on this. The management and ad hoc reports, because leasing actually does affect some cash flow items. It is going to affect some of the management reporting, so to think through that as well. Future state activity is fairly simple. That's just your modifications, renewals, terminations, early terminations, buyouts, etc. How is it that's going to be taken into account going forward for your lease portfolio, and who's going to be doing it? Finally, you've got to have your IT controls in place. That's not necessarily just for audit. It's to understand as well that you've got the appropriate team members interacting with the system that you might have adopted. So if you've implemented a system and you might have a temp working in that system, you could have a lease agreement that has been renewed quite easily, but then does that become a remeasurement event? Does it become a modification as a brand new lease in the system? These are the sort of questions that need to be asked, and it'll all be based in the theory that Amelia covered earlier. So, thinking through the iceberg icon, I think this one I wanted to use as something that was useful. Just if you're sitting on the call thinking, hang on, how could this be so complex? It's just extracting data from agreements and putting it into a system. What else is there? I'm hoping that this operates as a framework to illustrate where we have a lot of the problematic implementation areas. So going through portfolio completeness, that's going to be embedded leases, but also just understanding what leases you might not understand and not know that you have yet that would say lease agreements on them. There's the data side of it, the technology implementation, the teamwork, making sure that the skill sets are right, and then the future state design. So let me just spend 2 or 3 minutes digging into each one of these, starting with the portfolio completeness. So obviously the embedded leases is the first part. There's no real standard operating procedure for knowing how to find embedded leases. So you've got to come up with, I think every company has a different way of cataloging their data. So you've got to know what to look for. What data do you have at your disposal that you can use to identify these embedded leases? We've seen many different ways of approaching that. So the data is often also, in different areas. We have 50 different spreadsheets that we need to review to understand what assets these are tracking and if leases might be in them. And then all of the amendments and renewals that need to be included. So great example is a timing issue that we commonly see during the adoption process. Let's say we start on July 29th today for an adoption as of 1/1/2022. We abstract all the leases in the first 3 months because it can be quite a time-consuming process. And then we're happy we've got all of our abstracted data. But then what happens between July 29th and the end of December 2021, when a lot of those agreements have been renewed? So now you have to go back and review that population to understand what renewals, modifications, or terminations might have happened. So, the suggestion there, beginning with vendor assessments, moving into the documentation process and clearly documenting the procedures and the steps taken, and then engaging the auditor. I want this to be a really front and center point that I'm making here. engaging with your auditor upfront and early is exceptionally important. Have them buy into the approach that you're taking. Otherwise, you're going to find yourself adopting and they're going to require some rework. The auditors have been very strict on how this adoption has happened. The second is talking through data abstraction and normalization. Another big thing, obviously, whoever is doing the data abstraction needs a clear and in-depth understanding of the standard, because a lot of the data points actually do have an element of subjectivity. They need to understand how the guidance filters through to these data points. So the professional judgment and scrutiny needs to happen. You cannot have some temp who's perhaps doing his undergrad and looking for a bit of extra cash to do this, unless they really do understand how the guidance is to be applied. So this is often underestimated, and this is where we always recommend cross-functional team on the abstraction, and that cross-functional team needs to be, it needs to have an SME, it needs to have a leader, and I'll touch on that a little bit later when it comes to the collaboration and teamwork, but also developing a quality control plan. So understanding that there needs to be somebody who's doing spot reviews on the abstraction. The technology point is interesting because that's one area where we found a misconception that technology is going to solve your problems. It's critical to understand that it's garbage in, garbage out. Tools like Trullion are very robust. They can cope with a lot of different requirements. However, if the underlying data that's gone into them or the handling of the system is inappropriate, it's not going to produce the results that you need. I just want to highlight the third bullet point on the left here. MS Excel does not work for adoption, and that's not entirely true. It does for a small portfolio. It'll be absolutely fine. Where the complexity comes in and where tools like Trullion become very valuable is where your lease portfolio starts to change and you start to get more leases. It's the activity increases, you terminate, you buy out, and you go through M&A activity. If for M&A, you're going to have to start to now include, if your acquiree has not adopted 842, you're going to need to put that into your portfolio. So it really is a best practice to have a tool in place. I would highly recommend it. And penultimately, we've got the teamwork and collaboration that I need to just talk through. I alluded to this earlier. Across the cross-functional elements of the adoption speak to what Isaac mentioned earlier, where it's very siloed. So you've got your procurement, you might have operations, and they are interacting with these leases all the time. They have the institutional knowledge. You've got to be extremely careful to understand that they have the knowledge that must be applied to some of the subjective areas of the data abstraction. So this is not an accounting problem. It is an organizational issue that needs to be applied. So, for any CEOs that might be on the call now, this is not just a CFO's problem. Often the CFO office is the unfortunate recipient of this responsibility, but we need to understand that there is a cross-functional element to this effort. The final point I want to raise here is just thinking beyond implementation. And this speaks to, what I was saying. Ultimately, we've got to think, what does your day 2 and beyond look like? Don't think just purely getting compliant with the standard. We need to understand how we're going to consider all of the activity going forward. And I've got M&A here as well. That's an area that we've seen a lot of complexity, where if you are, as a company, deciding that you want to engage in M&A activity, how are you going to handle that? Has your acquiree adopted 842? If not, who's going to take on that responsibility, because auditors are going to want to have a look at that. So that's the final point. And I think with that, we're going to, I know that I went through that fairly quickly, but appreciate the opportunity to speak with you and hoping that these slides would act as a guide for implementation. But with that, we're going to move on to polling question 4 and hand over to Michael.
Thanks, Craig. Great wrap up. And, so we've got a couple of things. Polling question number 4 should be up now on your screen. What is the size of your lease portfolio? 1 to 10 leases, 10 to 50, 50 to 100, greater than 100 leases. We'll hit a couple of Q&A if we can just sneak 1 or 2 in here. Because I'm going to paraphrase a little bit, because we had several come in about IDR and the private company election that FASB's provided. And I think in light of how that if they use the private company election, the risk-free rate, which is a nice shortcut, but what are the shortcomings of that if you've got investors or lenders that don't think that's a good rate, or if you're going to exit the private market through a capital markets transaction at some point, an IPO of some sort, what's the downside of using that private company election, Craig? Craig, you're muted.
Thanks, Michael. My answer was really good,
Yep.
by the way.
I bet.
It really shows an in-depth understanding of the complexity of the standard, that question. So I appreciated that a lot. And basically, I think for the risk-free rates, that is really designed for small companies, tiny leaseholds that can adopt the standard easily. If you are considering M&A, I would modify our previous discussion on a best practice of using the risk-free rate, because if you're considering a IPO, any kind of public transaction in the near future, investors will require a risk-adjusted IBR to be used. So I would discuss with the auditors up front, because you don't necessarily want to you don't want to select an IBR rate now only to change at a later stage. But what I would certainly suggest is to maintain course of discussing it with the auditors to see how best to not double up that effort. Do it now and then do it again when you go public. So that's my assessment there. Fantastic. I see the majority of the portfolio here falls into the 10 to 50 leases, but I think wrapping up here, would like to thank the audience for joining, much appreciated. We did get some questions that we weren't able to address, so we'll do that. We'll do that offline. We'll reach out to those individuals that have asked questions, and look forward to having the further conversation. Please look out for our next Ask the Expert series, and we'll continue with our publications of 842 related material, and wishing everybody a fantastic rest of the week and a great weekend. Thank you all.
Yeah. Thank you. Thank you all. Thanks.